We came across a YouTube video by Patrick B. David that delved into the real reasons behind the delayed market crash. Impressed by the video's thoughtful construction, we felt the need to share our thoughts and emphasize a crucial point in response. Numerous creators have produced videos predicting a significant recession, evident in the numerous thumbnails depicting a market downturn. Despite the popularity of such predictions, it's important to recognize that there is substantial data supporting the likelihood of a recession. Our aim is to build on Patrick's insights by underscoring that should a recession occur, the data guides us towards the most effective course of action. At the beginning of the video, Patrick presents a chart illustrating the rapid increase in interest rates. He highlights that the United States has historically never raised interest rates by 4.88 percentage points as swiftly as it did recently. The visual representation depicts the speed at which the rates were raised, with the yellow portion on the left indicating the rapid pace of these increases. The chart essentially illustrates that over the past 35 years, while the United States has increased interest rates to levels higher than the current ones, the unprecedented aspect lies in the speed of these increases. Even during the period of relatively quick interest rate hikes from 2004 to 2006, the pace was nowhere near as rapid as the recent surge. The point emphasized is that the outcomes of such fast rate hikes are uncertain, as the real effects are not yet to be seen. This unpredictability was evident earlier this year when a series of banks faced challenges and broke down due to the unexpectedly rapid increase in interest rates. This caught many by surprise as it was not predicted at all. The lack of a predictable timeline is underscored by the unforeseen consequences of such quick changes. The next chart that Patrick presents adds another layer of insight focusing on the perspectives regarding the likelihood of an impending recession. This chart is particularly eye-opening, shedding light on the many opinions about the potential of a recession. What lies ahead for the US economy was investigated through a survey gauging opinions on the possibility of a recession. When examining the survey results, one notable trend is the response from the Federal Reserve staff, who unanimously assert a 0% likelihood of a recession. It's emphasized that this perspective aligns with their professional obligations given their role in economic management. Such a stance is to be expected, considering the context of Wall Street, where economic optimism is often upheld. Similarly, central bankers responsible for economic policies also echo a 0% expectation of a recession. However, there is an inherent bias in this self-assessment, as those in charge of economic decisions are unlikely to predict their own failure. Now let's talk about concentration. Among the 500 largest companies in the S&P 500, there are currently 7 companies that collectively represent 28% of the index. This situation is unprecedented in the history of the S&P 500. Looking at historical trends, a more concentrated S&P 500, particularly among a few top companies, has often led to unfavorable outcomes. To provide context, in the last 35 years, the top 10 companies in the S&P 500 typically represented no more than 20% of the index. However, before the dot-com bubble burst, these top 10 companies made up 25%, and when the bubble burst, stocks lost nearly 50% of their value. The last instance of significant concentration was in 2022, with 7 stocks making up 29.1% of the index. When the market crashed, it lost 20% of its value. It's important to clarify that this doesn't necessarily mean history will repeat itself, but it does highlight a concerning trend. The stock market has been propped up by the success of the top 7 stocks, and this concentration isn't a positive sign. Historically, when the largest companies thrive while the rest of the market struggles, it has often been an indicator of potential challenges ahead. On top of this, the consumer credit card debt in the United States has exceeded $1 trillion, reaching an all-time high. This, coupled with persistently high interest rates, raises concerns about financial well-being. Additionally, considering the personal savings rate during the pandemic, it initially surged to as high as 32%. However, over the following years, it declined as people increased spending, largely influenced by high inflation. The inflationary pressures were to a significant extent attributed to the substantial amount of money printed by the government during this period. The likelihood is that the personal savings rate, which had previously seen a decline, will probably decrease further. This is anticipated as student loan payments resume in October, leading to higher monthly payments. Consequently, the middle class is feeling the squeeze, with increased financial pressure. Although there isn't a crash yet, the ongoing squeeze on the middle class due to high inflation, resumed payments, and reduced savings implies less money available for investments. Furthermore, One compelling piece of evidence suggesting that we technically haven't experienced a recession yet is the lag effect. It depicts the Fed fund rate and the time in months from the last series of rate hikes preceding each recession since 1981. The pattern typically involves a continuous increase in rates followed by a period where rates remain unchanged before a recession hits. On average, it takes about 11 months after the Federal Reserve stops raising the federal fund rate for an official recession to occur. According to the CME Fed Watch tool, there's a 99.9% chance that rates will stay the same. If this prediction holds true, considering the last rate hike was in July of this year, we would anticipate feeling the effects between June and October of 2024. However, if the CME Fed Watch tool is incorrect and rates increase on November 1st, it would likely be the final hike. In this scenario, we would count from November, projecting the effects to be felt between October 2024 and June 2025. These predictions are based on the assumption that the current economic conditions, set in motion by rate hikes and other factors, cannot be reversed. The actual occurrence of a recession will depend on how these factors play out over the coming months. Given the concerns about a potential recession, high concentration, and the prospect of a market correction, the question arises, why invest now when one could potentially wait for the correction, anticipate the recession, and then capitalize on the market dip? However, rather than attempting to time the market with a strategy of buying high and selling low, we suggest a commitment to dollar cost averaging. This approach involves regularly investing a fixed amount, regardless of market conditions. We also want to highlight the counterintuitive nature of market movements. We've noticed that the best days often come after the worst days. Acting on emotional impulses such as selling during the market downturns and waiting to reinvest until recovery can lead to missing out on crucial gains. We strongly advise against trying to time the market. Instead, we believe it's crucial to build an emergency fund and make ourselves indispensable at work. This strategic approach, focusing on financial stability and job security, is particularly important during economic uncertainties like recessions. Our goal is to ensure a solid footing in challenging economic conditions. Well, that's about it for today's video. If you like today's content, do give us a like and remember to subscribe. Thank you so much for watching, and we'll see you next time.